Hello, this is Mike Swanson. I'm speaking with David Skarica of AddictedToProfits.net. How you doing today, Dave?
Hey, I'm pretty good. How you doing?
Oh, I'm doing great. Well, thanks for taking the time to do this interview. We've spoken over the years, and most people should know, you're basically an expert on the mining stock world. That's how I got to know you way back in 2002. And I've been getting a lot of emails from my free email list over the past couple weeks from people interested in uranium stocks. I know uranium was red hot like several years ago, and the uranium stocks did incredible. And going into the end of the year, they exploded up again. There's an ETF, URA, that tracks uranium stocks. It was $11 in November, and just a couple days ago it was 17. Although today it was down 7.58% to close at 1537. So we've dipped back down. And going into this, I've got so many emails from people wanting to know they should buy this uranium stock or that uranium stock. So do you think today's a great buying opportunity? We finally got a dip.
If you go look at the uranium stocks, the chart, like that URA you're talking about, you've got basically like a year and a half long base between about $11 and $15 a share. And we actually broke that on pretty good volume, in the last few months. And today we were down on pretty good volume. And really, if this is a real breakout, you should hold like the $14 to $15 area, I would think. And right now it's almost right back down to 15, and consolidate and then move higher again. So I had one uranium stock and I actually sold it. I made a very tiny profit on it. And here's the thing about uranium is that, this chart action isn't bad, but the problem I see is two major factors. Number one, I really think that, and I made some money in some oil stocks in the last few months and I sold them. I sold actually my last of my oil stocks today too, is that number one, uranium is an alternative to energy, okay? Now, uranium does have some of its own supply-demand characteristics, like places like China can continue to build nuclear power plants as to diversify in energy. But for the most part, every form of alternative energy, from wind to solar to uranium, really gets priced on what oil is doing. And what I mean by that is oil and gas, and natural gas is still the cheapest energy we have. So if oil and gas go down in price, it means that solar or uranium or nuclear power have to go down in price even more to be competitive with natural gas, which still is the cheapest form of production, energy production. So the problem with uranium is if oil and gas are topping out, and it really looks like if you go look at oil, we had this little rally based on the OPEC cuts, and it does look like we're building a top between $50 and $55 a barrel. We were down over 2% today, and if we break 50, it looks like we're going back into the 40s, and then at the very least we're going to be in a trading range of the early to mid 40s to the low 50s, and maybe even this is just a big bear market rally since early 2016. That we could even retest those lows because there's still a huge glut in oil supply. So if oil does roll over, that's a big headwind to the price of uranium. And then the other problem I see is just what you're talking about. This is the only mining sector that I have seen in recent years where now retail investors are getting really excited about it. They really think uranium stocks are going higher. I get emails about it. Like you said, you get emails about it. And that worries me because the only other time I've seen that since commodity stocks really rolled over in the last 5 years was probably last summer in the gold stocks. After having a huge 6-month rally, all of a sudden I started getting all these emails in gold stocks and people buying gold stocks in June and July when they should have been buying in January and February. So I'm a little more apprehensive here. And like me and you, we follow psychological and technical indicators in the stock market, like the U.S. stock market. And Investors Intelligence, which is a poll of letter writers today, showed 60% bears to 60% bulls to 17% bears. And this is one of the highest ratios of bull to bears that we have seen in years in the stock market. And if we do have the headwinds of the market topping out and seeing some form of correction or even bear market, it's going to be another headwind for commodities, uranium stocks, whatever. So like, look, they did break out of a technical base. Some of the technical action's okay, but they also went down today in big volume. So I'm a little apprehensive, and I do think at the very least, if they are going to move higher, you've got this consolidation that has to happen now. And it's just like, the way markets trade, it's hard for me to see a lot of these stocks are really going to break out and go to all new highs when Cameco was down 18% today on a record volume.
Well, why is that stock important?
That doesn't usually pretend to some huge breakout about to happen,
Why is Cameco important for uranium stocks?
Because Cameco is the largest, really the only real major large cap stock in the uranium sector. And actually, the last time it had a gap down like this on huge volume was actually in March of 2011, right when the uranium stocks topped.
Oh. Well, I don't know. I'm not going to buy them. I'll let someone else buy them and see what happens. That's a little crazy. Oh.
Yeah, and like I said, it's just, I don't know. It's just, look, I just kind of reverted. We had this discussion. Mike and I talk almost every day, is that, right now it's very slow. There's not much going on in the market. The market sees these bottoms followed by big rallies and these huge sideways movements and then sells up again. It's kind of been the Groundhog's Day scenario over and over again, over the last few years. And look, I'm sticking to my guns where, I own a couple beaten up stocks. I own some precious metal stocks, but I really think we are in a stock market bubble. We are hugely overvalued, and this thing is going to crash at some point. And look, I know people who thought like that in the late 90s, and they were wrong for 2 years, 3 years. And then in 2002, because they were patient, they got to pick up some great bargains on companies. So my philosophy is I don't care if the S&P goes to 2,400. I don't care if the Dow goes to 21,000. I don't care about the last 5-10% move in the bull market. I rather just stay on the sidelines, keep my powder dry, as they say. And look, in 2009, you could have bought Las Vegas Sands at $1.25. The thing is $55 right now. You could have bought Tata Motors, because we did in my newsletter at 35. It's over 30 right now, went to over 50. These are the bargains you get in a bear market. You're not going to get that right now. You and I, one of the few markets you could have done this in recent years was Greece in 2012. You could have bought HL Toy, the Greece telecom company, at 70 cents, and it went to $7. That is what is appeasing to me, not trying to chase all these stocks higher. And really, and the last note I'd like to make, Mike, is that we are now in the third longest bull market ever. The only two bull markets that were longer were the boom of the 20s and the boom of the 90s. So the other two long bull markets were big, real economic booms, which we haven't seen. And I think what happens, because the length of this bull market and the amount of cheap money that's out there, we're just chasing, for a few months, financials will be hot. For a few months, uranium will be hot. And then these big rallies really don't go anywhere. For a few weeks, shipping stocks were hot, right after Trump got elected. So that's what we, in 2014, the FANGs did poorly, but in 2015, they did great. So we just see like money sloshing around and chasing after odd sectors, and a lot of the times it doesn't even lead to anything,
Well, what do you think are the best places to make money in this year? Are you still interested in gold? Because we were in gold, last year we're still involved in gold, but that was really where we made most of our money. Both of us, we were, telling people to buy in January and February. It was a tremendous rally. We did caution people though in the summer about lightening up, but we haven't really talked about it since then. So publicly, at least. So what are your thoughts on gold now?
Yeah, right now, I wouldn't be chasing any gold and precious metal stocks here after this recent rally. I think that we're going to be in this choppy consolidation, still consolidating from the highs of the summer. And a lot of times these gold stock consolidations can last 6 months to 12 months. So it could last maybe into this summer. But definitely on these pullbacks, and I think now we have a line in the sand, with the GDXJ bottoming at around 27.5. The GDX bottomed at 19. I think these now become support levels, and if you pull back towards those levels, you can look at buying the gold stocks there at those levels. And with me too, I do a lot of fundamental research and technical research on individual companies. So I have a couple companies on my list which I think can actually move higher regardless of what the market does. I have stop losses on them too. But one company in particular right now is looking really good right now. It's got a big base forming. I'm not going to give it away. It's actually a tech company. And it's approaching its 200-day moving average. And I think it's only about 2% away from that. And I think if it can break the 200-day moving average, it can really shoot to the upside. So that's kind of what I'm looking at here.
Well, you're more interested in buying things before they move up really high, like this setup you're speaking of right now. And we're running a special offer for people to get into your service. So I got a link to that below the interview. For anyone who takes advantage of it, they'll get these ideas of yours. And it's also, I think, important for people to be able to create a list of stuff to buy for when there is a dip or what to buy in the mining sector. So I think it's a real critical thing to get involved with.
Yeah. So I have mining stocks on my list, but here's something I'm going to do in an upcoming issue. And if you sign up to my service, you can get an issue that I did last December. And what I talked about in this issue is reflex rallies. And George Soros invented this term called reflexivity. And basically that means in a nutshell, markets shoot over to the upside and then crash, and then they crash and go too far to the downside and then have big rallies. So what I did is I showed this example. I talked about Las Vegas Sands just earlier, but I gave examples of stocks like Las Vegas Sands, Crocs was another one back in 2007, 2008. Examples of companies that went down 90, sometimes even 99% in price, and then after the bubble burst and after they collapsed, actually saw rallies of not only the hundreds, but thousands of percent. So what I'm going to do in this upcoming issue is give you stocks that have already busted, but I still think can have this final leg lower if we do see a bear market or bust in the markets. That's probably what's going to take for them to have that last bust. And then these are like a stock, a list, like a shopping list, like you just said, a company you could probably buy. And then when the market does bust and bottom, you'll be able to have these 5 or 10 stocks on your list and really be able to profit from that, going forward, in the markets. So that's not, this is not usually a way to sell newsletters, right? This is not a way to be exciting or sexy, but I just think in the long run, you're going to make a lot more money using that kind of philosophy. And when the market's busting, you just won't have your head in the sand or up your you-know-what like everyone else in the market who's losing their you-know-what. You'll actually have this list of stocks that you'll be like, okay, Dave gave me this list of 10 stocks, and, the market's busting. This was a $60 company. Now it's a $1 company. And if we just see a 6 to 12 month rally in the stock market, this thing can rally to $5, $10, $20 a share. So that's kind of what I'm doing as well. So I'm kind of eclectic right now. I like the gold and precious metal miners on dips. I like a handful of these kind of, I've actually got 3 companies. One is a healthcare company, 2 are technology companies that are really beaten up, and I own them too. So I kind of have this eclectic list. And actually, I'll tell you what else we're doing. We're doing these strategies where, for example, Netflix reported earnings, as we're speaking here, and it's up $11 or 8% after hours. Well, what I did is I did a put call trade where if the market busts this year, obviously a company like Netflix is going to completely fall apart, but it's still going parabolic in its uptrend. So I did this trade where we bought some calls and puts on it, and the idea would be if Netflix gaps up on its earnings like it looks like it's going to do right now, you can sell the calls into that. You still and then average down on the put position, and then if you get this sell-off over the second half of the year or something, or in the middle of the year, then those puts will do well. So we're kind of doing strategies like this as well if you're interested in doing options.
Yeah, so in that way you're benefiting no matter which direction it moves, just as long as it moves. And boy, we got to move right now on Netflix, at least in after hours. Who knows where it'll be tomorrow? But it's going to be all the talk on TV for sure.
Yeah, and to be honest with you, some of these strategies I'm doing, Netflix probably is the only one of those main stocks I'm doing them on right now. I prefer, there's another stock that's called Parabolic, which I'm not going to name, that I'm going to buy puts on, it started to break in recent weeks. But I prefer these kind of second tier names because I don't find you have the premium in the option markets. You don't have all the hype around these companies and stuff like that. Netflix was just one I like. Because I like, nothing we're doing with seasonal trades is, I mentioned this beat up tech company I have. Well, this particular tech company reports in a couple of weeks, and historically it always gaps up on its first quarter earnings. Well, one reason I did this put call trade on Netflix is the first quarter earnings tend to be Netflix's strongest earnings, the one that always gaps up on. So I'm like, I still want the puts as a hedge, but I'll buy these calls because historically this is the strongest time period for Netflix. So these are the kind of strategies I'm doing as well. And another thing I'm doing is I'm talking about the market is I'm having a 2-to-1 put to call ratio, meaning that say you have 15,000 to play around in options, I'll buy 10,000 of puts, and 5,000 of calls, because I still think the leverage is in the put side, because the market's not going to go up 30% this year, okay? But it might go down 30%, but I'll buy these calls, and if these companies do well, those calls to double or triple, and I'll make back the money I lose in the puts. And if the market completely falls apart, these puts will skyrocket. I won't care about that little bit of money in the call. So I'm doing this strategy as well, so people are interested in that. I think it's a little more market neutral, but it also will make a large amount of money in a bust. But look, I'm just sick of sitting there. We never know when a bust is going to happen, and who knows if it happens next week, next year, next month. It's like nobody really knows that. So but buying some of these gold miners on corrections, a select number of companies to short, doing put to call strategies, hedging market risk. That's essentially what I'm doing this year. And again, having some beaten up companies that I have select positions in.
Well, great. And thanks for taking the time to talk to me and everyone else. We'll do more interviews this year.
Yeah, thanks for having me.